Normally, a 77% spike in fuel costs would just completely force an airline to hemorrhage cash, right? Like ground planes charge you for the luxury of a cup of water just to survive.
Oh, yeah, absolutely.
Because the airline industry is, historically really brittle. Like a slight breeze in the broader economy or a minor shock to oil supplies, and the whole house of cards collapses.
It's true.
But today, we are looking at something that completely breaks that traditional model. Welcome to a brand new deep dive. We are digging into Delta Airlines' official June quarter 2026 financial results, which were literally just released today, July 10th, 2026.
Fresh off the press.
Exactly. And our mission today, because I know looking at corporate balance sheets can sound dry, our goal is to help you understand the fascinating mechanics of how a modern global airline is actually thriving right now. I mean, they are pulling in record revenue while simultaneously navigating honestly, historically massive fuel costs.
It really defies the conventional wisdom of airline economics, to be honest. The central tension in this report is just striking. They delivered a highly profitable quarter while absorbing the highest quarterly fuel expense in the entire history of their company.
A $1.4 billion pre-tax profit sitting right next to record-breaking fuel costs. Those two realities, I mean, they usually do not exist in the same universe.
Oh, they don't.
If my biggest variable expense jumps 77%,
Yeah.
I couldn't just pivot and declare a billion-dollar profit.
Yeah, okay.
Okay, let's unpack this because to understand how they pulled this off, we really have to look at how a modern global megacorp actually functions under extreme pressure.
Right.
So let's start with their revenue engine because the first big takeaway here is where the money is actually coming from, right?
Yeah, and the sheer volume of that money is staggering. For this June quarter, Delta reported a record adjusted operating revenue of $17.7 billion.
Wow, $17.7 billion.
Yeah, that is a 14% increase year over year, which means they pulled in over $2 billion more than they did in the exact same quarter last year.
That's insane. But, the total number isn't even the real story here. It's the architecture of that revenue.
Yeah.
We often think of airlines as flying buses, right?
Mm-hmm.
Like you buy a standard ticket, you get a seat, they take you from point A to point B.
Yeah.
But looking at these mechanics, Delta is operating much more like a luxury lifestyle brand or a members-only club.
That's a great way to put it.
Because premium revenue grew 17% year over year.
Mm-hmm.
People are aggressively opting out of basic economy.
What's fascinating here is how Delta has fundamentally re-engineered its core product. I mean, main cabin tickets are still vital, of course.
Sure.
In fact, main cabin unit revenue grew double digits for the second consecutive quarter, but they have effectively decoupled their financial success from basic ticket sales. Diverse revenue streams now account for 61% of their total revenue.
Wait, 61%?
Yep, 61%.
So the vast majority of the money they make doesn't even come from someone buying a standard coach ticket anymore.
No, it's up 2 points from last year. And a massive, undeniable driver of this is the SkyMiles ecosystem.
Yeah.
It's not just about the physical act of flying anymore. It is about the broader consumer economy. Which brings us to the $2.4 billion elephant in the room.
American Express.
American Express. The remuneration from Amex to Delta hit $2.4 billion just for this 3-month quarter alone.
It is just for one quarter.
Just one quarter. And that figure grew 16% over last year.
See, if you think about the mechanics of airline miles, they essentially act as a fiat currency.
Right.
Delta mints these miles at a near zero marginal cost. They sell them in massive bulk to Amex, and then Amex uses them to incentivize your everyday spending. When you use that Delta Amex at the grocery store or, the gas station, Delta gets a cut.
Exactly.
It's an incredibly high-margin feedback loop that operates completely independently of whether their planes are full.
Precisely. They are seeing accelerating card acquisitions, marking the 7th consecutive quarter of double-digit year-over-year growth in cardholder spend. Plus, their travel products and non-air partnership revenue increased nearly 20% over the prior year. They're basically monetizing the consumer's entire lifestyle.
And this extends right into the corporate world, too, which actually really surprised me.
Yeah,
because over the last few years, the prevailing narrative was always that business travel was permanently wounded. Like Zoom and video conferencing killed the business trip.
Oh, sure, the whole remote work shift.
Right. But looking at these corporate sales figures, that is demonstrably false.
Very much so. Corporate sales accelerated, growing double digits across all sectors. It was specifically led by aerospace and defense, banking, and automotive.
Okay, banking and auto. makes sense.
And returning to your point about the members-only club feel, sustained strength in premium product demand drove a more than 25% increase in premium corporate sales.
A 25% jump in premium corporate. That tells me companies aren't just sending their executives back out on the road, they're actively paying for retention and comfort.
Yep.
They are paying for a Delta Comfort Plus or Delta Premium Select because the competition for talent demands it. They have successfully captured the high-margin business traveler.
It proves that their heavy capital investments in outfitting those premium cabins are yielding a direct return.
But, okay, there is a massive friction point here. It's great that they are generating $17.7 billion in revenue, but flying those premium passengers requires jet fuel.
And a lot of it.
Exactly. And the commodities market has been brutal lately. So how is the bottom line actually holding up when the cost of running the actual machine is skyrocketing?
This is where we truly test the durability of their business model. Delta's adjusted fuel expense skyrocketed 77% year over year, hitting $4.4 billion.
$4.4 billion just on fuel.
Right, and that's an adjusted average price of $3.93 per gallon.
Man. And I saw they even factored in an 11-cent per gallon benefit from their Monroe refinery, and it's still at nearly $4 a gallon.
Exactly. And this is where we have to look at the shock absorbers they have built into their operations. Because to survive a 77% variable cost spike, you have to ruthlessly control everything else.
So how are they doing that?
Let's look at their KSMX. That's their non-fuel unit costs. They managed to keep that increase to just 6.8%, coming in at 14.09 cents.
So they are aggressively stabilizing the costs they can control, like gate leases, labor efficiencies, and, administrative overhead, while the costs they can't control just go through the roof.
Correct. And management noted that this non-fuel unit cost performance is expected to improve sequentially in the September quarter.
Oh, really?
Yeah, and progress even further in the December quarter as their capacity growth normalizes. They're actively targeting a return to a long-term framework of low single-digit non-fuel unit cost growth.
But controlling overhead is only half the battle, right? The second major shock absorber they've built is something that I just find completely brilliant.
The B2B side.
Yes.
Yeah.
It goes back to those diverse revenue streams, but strictly business to business. Look at their MRO revenue. It jumped 32%.
Yes, the maintenance, repair, and overhaul division. Delta basically operates a highly lucrative mechanical shop for other airlines.
Which is wild to think about.
It is. That 32% growth was primarily driven by work on legacy engine platforms. They specifically noted growing their MRO presence and partnership portfolio with Indigo for CFM56 engines and with LATAM for A320 components.
Which makes perfect mechanical sense. Right now, there are huge global supply chain constraints for new aircraft. Because airlines can't get new planes fast enough, they're forced to fly their older legacy planes a lot longer.
And those older planes require much heavier maintenance.
Exactly. Delta is perfectly positioned to capitalize on that macro trend by fixing their competitors' engines. Add to that their cargo revenue increasing 39% based on pure volume, and you really start to see the safety net.
If we connect this to the bigger picture, this is a masterclass in corporate resilience. A brittle company facing a 77% fuel hike would have posted a devastating loss this quarter.
Absolutely.
But because Delta has diversified into acting as a high-margin credit card partner, a premium corporate transporter, an international cargo shipper, and a massive auto shop for commercial jets, they absorbed that multi-billion-dollar hit and still posted an 8.8% adjusted operating margin.
It is the definition of insulating your balance sheet.
Right.
But, here is the immediate danger.
What's that?
Well, if you are aggressively capping your non-fuel costs to survive that massive fuel spike, the traditional airline playbook says the passenger experience is going to degrade, right?
Usually, yes.
Cost-cutting usually means broken seats, delayed flights, and terrible service. But Delta relies on a 17% growth in premium revenue. You cannot charge premium prices for a miserable cost-cut experience. So how are they justifying these price tags on the ground?
Operationally, they are executing. For the quarter, Delta led all competitive carriers in on-time arrivals and departures.
Which is huge.
It is. But to your point about the premium experience, they are investing heavily in proprietary technology to remove the most persistent friction points of travel.
And here's where it gets really interesting. Because on-time performance is just the baseline. They actually set an all-time Delta record for their domestic mishandled baggage rate this quarter.
They did.
And they didn't achieve that by just, Yelling at baggage handlers to move faster, they rolled out a proprietary baggage AI technology at their hub in Atlanta.
This integration of AI into physical logistics is truly remarkable. This baggage AI drove a year-to-date improvement in Atlanta's mishandled baggage rate of over 25% compared to last year's baseline. And in June alone, that improvement spiked to 50%.
50% fewer lost bags. I mean, losing luggage is the ultimate travel nightmare. It completely ruins the premium illusion. What they've done is build a system that uses real-time optical data and computer vision at the conveyor belts.
Right, it tracks the actual bags.
Yeah, it acts like a digital air traffic controller, exclusively for your suitcase, predicting exactly where a bottleneck will occur before the bags actually pile up. They are actively using tech to solve the oldest, most infuriating complaint in the airline industry.
And it goes beyond just mitigating negative experiences like lost bags. It is about actively enhancing the positive experiences to keep you locked into that SkyMiles ecosystem we discussed earlier.
The psychological lock-in is everywhere. Look at the Wi-Fi rollout. Over 95% of their aircraft are now equipped with fast, free Wi-Fi for SkyMiles members.
And they are heading 100% by year-end, bringing new satellite upgrades online for faster speeds and broader global coverage.
But the catch is crucial, right? It is only free if you are a SkyMiles member. If you want the Wi-Fi, you have to join the club, which immediately pulls you into their data ecosystem.
Exactly. And once you are in the club, the lifestyle integrations just multiply exponentially. Through their Delta Sync partnerships, they have onboard collaborations with The Wall Street Journal and Fox One.
Oh, and the phone carrier thing.
Yes. If you simply link your SkyMiles membership to your T-Mobile account, you get a complimentary premium beverage on board.
Free drinks just for linking a phone carrier to a frequent flyer account. It is seamless data integration.
Furthermore, they relaunched and expanded a decade-long partnership with Airbnb, so SkyMiles members now earn miles on where they stay and on experiences once they arrive.
Okay, that's some.
They are also continuing to roll out a Delta Concierge to over 50% of SkyMiles members, which offers an AI-enabled digital assistant right in the Fly Delta app for self-service and instant messaging.
They are blanketing your entire journey. Think about it. From the moment you leave your house, the AI tracks your bag to the plane, you get free satellite Wi-Fi in the air, a free drink because of your phone plan, and then you earn miles while you sleep in your Airbnb.
They aren't just selling you a flight.
No, they are monetizing and optimizing your entire itinerary. And we have to talk about the physical infrastructure supporting this too. The lounges.
The lounges are vital to the premium strategy. They just opened a second Delta One lounge at LAX.
And second one just at LAX.
Yeah. That brings the system to 5 Delta One lounges, operating alongside 55 Sky Clubs. They also unveiled a next-generation Delta One suite for the incoming A350-1000 fleet, expanding their lead with the most business-class suites of any U.S. airline.
And they are actively expanding the actual network to deploy these premium products. They took delivery of 11 new aircraft in the quarter, A350-900s, A321neos, and A220-300s.
All highly efficient planes.
Very efficient. And they are putting them on high-yield routes. They launched daily non-stop service from LAX to Hong Kong and expanded European destinations to places like Porto, Malta, and Sardinia.
Which perfectly aligns with the premium consumer demographic they are targeting. Those are high-demand, leisure-heavy European destinations.
So the product is highly integrated, the tech is solving real logistical problems, and the network is growing. But this entire structure relies on human execution and a balance sheet that doesn't, collapse under the weight of its own debt.
Right.
How are they treating the workforce that actually delivers this premium experience and the investors financing it?
Well, it is a deliberate dual strategy of internal investment and aggressive deleveraging. On the employee side, they instituted a 4% pay raise for eligible employees worldwide.
A 4% base bump across the board.
Yes. And perhaps more significantly, for long-term operational motivation, they have already accrued nearly $500 million in profit sharing year to date.
Wow.
Which is set aside for next February's payout.
$500 million accrued in just 6 months. And this isn't just corporate charity, right? It is an absolute operational necessity.
How do you mean?
Well, you cannot maintain a 17% growth in premium revenue if your frontline gate agents and flight attendants are resentful. The entire premium strategy relies on the workforce feeling tangibly invested in the financial success of the operation.
Absolutely. It is an operational hedge.
Yeah.
Happy employees deliver the service that justifies the premium ticket price. And it's not just internal culture, it extends outward into the community.
Oh, the community engagement stuff.
Yeah, the report details significant civic engagements that actively build brand preference. For example, Delta transported over 24 WWII veterans from Atlanta to Normandy for the 82nd D-Day anniversary ceremonies.
It's a massive logistical commitment that really humanizes the brand. And I saw they were also recognized as the #1 corporate blood drive sponsor with the American Red Cross for the 9th consecutive year.
Yes, collecting nearly 16,000 units of blood across almost 400 drives.
It shows a level of civic integration that directly impacts how consumers view the brand when deciding who to fly with.
But to sustain all of this, the raises, the AI infrastructure, the new Airbus deliveries, the financial foundation has to be actively managed. In the June quarter, they aggressively paid down debt.
No count.
They reduced their adjusted net debt by $709 million from the end of 2025. The debt now sits at $13.6 billion.
Paying down nearly $750 million in debt in a single quarter while absorbing record fuel costs is incredible financial discipline.
It really is.
Mhm.
The chief financial officer, Eric Snell, stated that debt reduction remains a top priority. They expect to reach a gross leverage of approximately 2x by year-end.
That's a solid target.
And this deleveraging, combined with generating $1.4 billion of free cash flow in the first half of the year, provides massive flexibility. And they are passing that stability on to shareholders, announcing a 15% increase to their dividend payment beginning in the September quarter.
So they were rewarding the employees with $500 million in profit sharing and rewarding the shareholders with increased dividends.
Exactly.
So what does this all mean for the rest of 2026? Does this momentum hold, or are they bracing for a slowdown?
The guidance is highly optimistic. For the upcoming September quarter, Delta expects revenue to grow in the mid-teens over the prior year. They are projecting an operating margin of 11 to 13% and earnings per share between $2 and $2.50.
And for the full year?
They firmly reaffirmed their full-year guidance set at the start of 2026. They expect to grow earnings by 20%, resulting in an adjusted EPS of $6.50 to $7.50.
Okay.
And they expect to generate a free cash flow of $3 to $4 billion. Again, all of this is projected while overcoming what CEO Ed Bastian explicitly called a multi-billion-dollar fuel headwind.
Okay, let's bring this all together. What we've unpacked for you today is basically a blueprint for corporate resilience. Delta Airlines is not just surviving a historically unprecedented spike in fuel costs.
No, they are thriving. Right, because they fundamentally re-engineered the mechanics of their business. They leaned into premium experiences to capture the high-margin traveler. They deployed proprietary computer vision AI in Atlanta to fix the logistical nightmare of lost baggage. And they insulated their balance sheet by running a massive mechanical shop for their competitors.
And crucially, they decoupled their survival from the simple act of selling a coach ticket. They locked you, the consumer, into a highly lucrative ecosystem driven by a $2.4 billion American Express partnership, integrated Wi-Fi, and lifestyle brand collaborations.
They monetized your entire itinerary, from your credit card swipe at the grocery store to your Airbnb booking in Sardinia. It is brilliant business.
It is, and this raises an important question, something for you to think about, as this ecosystem model proves to be so wildly profitable.
Yeah.
We've established that Delta is functioning more like a tech-driven financial lifestyle brand than a traditional airline. But if aviation is becoming a highly lucrative, data-rich loyalty ecosystem, what stops an actual tech giant like Amazon or Apple from bypassing partnerships altogether?
Oh, wow.
At what point does a massive tech conglomerate decide to just acquire or launch their own airline entirely to lock you permanently into Prime or Apple One?
An Apple-branded airline where your ticket is just a perk of your iCloud subscription. That completely changes the landscape. That is a wild thought to leave on.
Thank you for joining us on this deep dive. The next time you walk onto a plane, look past the seats and think about the invisible financial mechanics, the B2B side hustles, and the AI making that flight possible. We will catch you on the next one.